You gotta be flipping my flapjacks. Holy smokes, this ain't no joke, as we got action all over this market. PayPal, we got a major development on the DL and we're not letting that slide. No, sir. Yes, there's something going on with PayPal. It matters significantly. News came out yesterday. No one paid attention to it, and I'm telling you, this is a massive deal. Shopify stock got Shopified today. Oh my gosh, 18.5% down. We're going to talk about what happened with Shopify. Is this a buy? Is it like, should we do the 3-day rule? The 3-day rule is essentially a thought process of let the stock continue to go down over the next few days, then go ahead and buy it after it's already been down for 3 days. We'll speak about that. We'll also speak about, would I be starting to buy this stock in the public account? I have a position in the Patreon portfolio, but what will it take for it to get in the public account? Wynn Resorts had great earnings. Stock did absolutely nothing. It went down 1.5% today on great earnings. We'll talk about why is there no move in that stock. Airbnb is getting hammered after hours, about 8.5%. Its friend Uber is down about 6% today. We'll talk about if Uber's a buying opportunity. We'll look at the earnings. We'll look at the balance sheet, all those things. Action-packed video. Appreciate y'all joining me as always. All I need from you guys, smash a like on this video and make sure you're subscribed. New all-time high subscribers in the history of the channel. It's such a big number that I don't even know what it is, but it's a big number, okay? Alrighty, PayPal. So we got a major development here, all right? So PayPal stock, this is a stock that's down 43% in the past 5 years. It's been a disaster stock, we can call it that, right? I mean, 43% down on a 5-year chart is pretty disastrous. Now, there's 3 core reasons why your stock goes down over time. And we can say, is it the fundamentals of the business? And the answer is are the fundamentals of the business, have they deteriorated to a point where that's the reason the stock is down? Well, if we look at the business, revenues are at all-time highs. If we look at operating income, all-time highs. If we look at net income, all-time highs. EPS, all-time highs. No, the business is better than it's ever been on a factual basis, right? PayPal is looking really, really good on the business fundamentals, and it just keeps getting better and better and better. So then you have to ask yourself, okay, is it valuation? That's why it's down, right? Well, certainly not anymore at this point in time. The forward P is 12 on this stock, which is so low it's gotten to kind of where banks trade at, like traditional old school non-growth banks, where they trade at. Forward P at 12, trailing 12-month P in the 15 range. We got a PEG ratio of 0.8 on this baby. So no, it's certainly not valuation. So what is it? It's got to be the third thing. And the third thing is Wall Street. It's got a Wall Street problem. If you're going to talk about stock goes down significantly over a 1-year span, 3-year span, or 5-year span, it's either because of business or the valuation is too high, or it's got a Wall Street problem. Clearly it's not valuation. Clearly it's not the business model. It's got a Wall Street problem. Now, do you remember hearing news just probably a couple weeks ago about Tesla's head of investor relations was leaving the company? And the stock actually went down on this, and a lot of people looked at it as a huge negative. And the reason being is this particular gentleman had been with Tesla for over 7 years. Check out Tesla's stock price over the past 7 years. It's been pretty phenomenal. And when you're talking about the head of investor relations, it matters significantly because these are the folks that deal directly with the analyst community. They are the ones that kind of guide analysts. And a good investor relations team can get a stock through a tough time without having to go down that much. And when times are good, the stock can really fly because they know how to talk to Wall Street. They know how to have these folks understand what's going on with the company and command higher valuations. A good investor relations team should be able to command much higher valuations than a poor investor relations team. If you want to look to one of the best investor relations teams in the world, look no further than Apple. Apple is one of the best investor relations teams in history. And those folks, like even when Apple's doing bad, which is it's actually doing bad, look at the stock price. It holds up tremendously well because the investor relations team has ways to pitch it. They have ways to bring down analyst numbers in between quarters so then Apple can come in and beat their earnings. It's magical. This is all stuff that kind of happens in the background, okay? Well, that leads us to PayPal. PayPal just named a new chief investor relations officer. Today, this was actually yesterday, Steve Wonkier has been named the Chief Investment Relations Officer effective May 15th, 2024. So he starts as of next week. And we should play a fun game. We should track where PayPal stock goes from May 15th, 2024 to May 15th, 2025 to May 15th, 2026. And let's see what happens here, okay? He's going to report directly to the CFO of the company. and communicating the vision and progress of PayPal's transformation to the financial community. Steve is a collaborative and trusted strategic advisor who brings a wealth of experience working with companies during transitions. His broad expertise, not only as an equity analyst, but also as an operator, makes him the right leader for this role. I am thrilled to welcome Steve to the team. Now, you may want to say, okay, where did Steve work right prior to this? This is very important. You want to say, was this man successful in his previous role? And if he was successful, how successful are we really talking, right? No different than when Alex Chris came over from PayPal. We want to look at his pedigree. Oh, he came over from Intuit. He was very transformative over the last 10, 15 years at Intuit. It's a great stock, right? He's got a great background behind him. So what about this gentleman? Well, check this out. This gentleman joins PayPal. He's coming over from GE, where he most recently served as the Chief Investor Relations Officer for GE Aerospace. Now, we'll look at GE's stock price year to date on a 1-year basis and 5-year basis in just a moment, and get ready to have your flapjacks flipped, okay? Now, prior to GE, he worked for UBS in several different roles at UBS. Sell-side research, marketing strategy, many different areas he worked for UBS. So he understands the analyst community, understands how to talk to these folks, how to get them to understand the company. These analysts then are the ones that kind of go talk to Wall Street, right? They are part of Wall Street, but they go talk to big money Wall Street is the way I should put it, right? They talk to, different funds, different fund managers, pensions. They talk to hedge fund managers, all these sorts of folks, right? You might have this assumption that a hedge fund manager is like sitting in their office and like reading 10Ks and 10Qs. It might be true for some, but for a lot, it's not. Hedge fund managers are more like buying art at an auction house and having champagne with other high net worth individuals and keeping good relationships. That's more what their days spent. If you ever got to hang out with a hedge fund manager that's a billionaire for a few days, you would find not much of their work is actually done listening to conference calls. And there's other people that are doing that, and part of that is the analyst community. He says, I am excited to join PayPal at this important moment in the evolution of the company. PayPal pioneered online commerce and has many strong assets to leverage as we drive profitable growth going forward. Alex and the management team have developed a strong plan to deliver for customers that will be exciting for shareholders. I look forward to working with investors to help them better understand how PayPal is executing over time, right? Now, how did GE do prior to him joining? Well, GE, 5-year performance, right? 234%. The stocks come in a PE ratio of 55. 55 on this company. A 1 year, 111% the stock has gone up. And year to date, the stock has gone up 66%. Now, GE Aerospace is certainly not the most exciting company out there, but their stock price has performed tremendous. And one of the big reasons, I think, is because of this gentleman and him being able to lay out the future and get folks on board and then play the whole, get the analyst community down, come in, beat numbers, get folks to understand, get fund managers to understand the whole game, okay? It's a whole big game. I told you guys this. Wall Street's a whole big game. A whole big game, right? For us as long-term investors, we got to stay focused on what's happening over the next 5 years and the fundamentals underlying with the company and valuations. But you got to understand, there's a lot more that goes beneath the surface that is this game of Wall Street, right? Now, Alex Chris, I told you guys when this man was coming in, I said he's not coming in to fix a broken company. He's coming in to fix a broken stock. That's number one. That's why Dan Schulman basically got booted out of this company. It was a nice way of putting it, I guess we say, right? Or maybe a non-PC way to put it. And Alex Chris got put in to fix a broken stock. The stock's broken, right? And also to improve an already great company, right? To get this company to move faster, innovate faster, do things faster, move better, improve growth rates, right? Not coming in to fix a broken company. Now, that leads us to Shopify, okay? Shopify. So the company, I would say, had a C plus income statement. It would have been a lot better than a C plus, but they had this one-time expense here of about $342 million that kind of killed their profitability for the particular quarter. But subscription solutions was up $129 million. Merchant solutions was up $224 million. Overall revenue was up substantially. And then you look at subscription solutions, that expense was only up $11 million versus our revenue was up $129 million. That's going to be great for your gross profit. If we look at merchant solutions, that was up 224 versus the expense, they're only up 182. That's great for your gross profit. And sure enough, gross profit, $957 million versus $717 million. So we can call it about $240 million up number on a year-over-year basis. Phenomenal. Now, sales and marketing, Shopify is spending aggressively there. Research and development, they actually brought that down significantly. G&A, they basically kept that in line, up about $1 million. Transaction and loan losses was up about $9 million year over year. Total operating expenses, they kept in check overall. They actually brought the number down, which was impressive, right? So income from operations, $86 million versus $193 million loss in the same quarter last year. Once again, the one-off kind of screwed things overall for Shopify. Now, the problem for Shopify, we do have a problem here, folks, okay? So analysts for this upcoming quarter were expecting just under 20% revenue growth, okay? Now, what Shopify said is Shopify is talking about growing revenue at a high teens percentage rate. So that basically kind of leaves the door open for, we can call it maybe 17 to 19%, right? Which is, we can call it, let's assume the midpoint's 18%. Well, that's not quite 20%, which is basically where analysts were at. And when you're Shopify and you trade at higher valuations, you have to, if anything, come in and beat numbers and, kind of take expectations up and up and up. You can't come in and, report something like that overall, right? Now, in regards to Shopify, the balance sheet is a grade A, right? I mean, you're talking about $1.6 billion of cash and cash equivalents, $3.5 billion in marketable securities, total stockholder equity of nearly $9 billion for this company. It's phenomenal, right? Shopify is a buy. Let's first start out by saying that. Okay, Shopify is absolutely a buy here. Shopify is one of the few companies in the stock market that every dip you get, every major dip you get in the stock, you buy the dip. It is one of those sorts of companies. It's, when does Shopify stop growing? I don't know. It's so long from now that I don't even know. It might be 10, 20, 30 years from now. It's like that far out there, right? I mean, for Shopify not to grow would have to mean like the biggest, greatest, and most insane recession ever or something like that, right? Like truly it's a special company. So every dip's a buy in this one, just as every dip in Amazon's been a buy the last 20 years, right? But the 3-day rule, I can kind of understand it making sense. Now, if you're in a bullish market, you have to buy dips right away. And are we in a bullish market? I wouldn't say at this point in time. I'm seeing way too much collateral damage out there in the market to say we're in a bullish market anymore at this point in time. Way too many stocks getting hit way too hard. No, we're not in a bullish market. We haven't really been in a bullish market, in my opinion, for at least 2 months now at this point in time. Are we in a bearish market? I can't necessarily say that either. I would say we're kind of in a kangaroo market right now, up and down. So the 3-day rule can make sense to kind of wait on it a little bit and, maybe let it, kind of fall apart here just in the short term, right? Now, will I be buying this stock in the public account, right? Because I have a position in the Patreon portfolio, but the big question is, what about Big Dog, right? $2 million plus Fidelity account there. Could I add Shopify in the public account? I'll say this. I'll say absolutely. Shopify deserves to be a position I hold in the public account. When I think about the big six, Shopify would fit so perfect in the big six, right? Meta, Tesla, Amazon, PayPal, Elf, Palantir. Yes. I need to add that stock in the public account. It would fit so dang good. No doubt about it, man. No dang doubt about it. I like to own companies that have so much growth over the next 5-10 years that I don't even have to stress over it, right? And when you look at Meta, Tesla, I understand the short term, but over the next 5-10 years, that company has so much growth, I don't even have to worry about it. I'm 0% worried about Tesla long term. Amazon, same thing. PayPal, same thing. Elf, same thing. Palantir, all those companies, all those big six, I don't even stress over them. I just know they're going to grow massively over this next 5-10 years, and that will be what that's going to be. Wynn Resorts. Now, Wynn had great earnings, and the stock didn't move. It actually went down 1.5%. You got to say, what happened here? Well, first off, were the earnings great? Absolutely. It was an A minus income statement here. Casino revenues 1.1 billion plus for this quarter versus 766 in the same quarter last year. Rooms were up to $327 million of revenue versus 272. Food and beverage was up significantly. By the way, Wynn Resorts, they have properties. The two main luxury properties in Vegas, Wynn and Encore. They have 3 properties in Macau. They got the Wynn Palace, the Big Beast, which is on the Cotai Strip. Then they have the 2 older properties, Wynn and Encore, on kind of the older part of the Macau area. Then they also operate the property in Boston, and they have other projects going on right now as well that aren't operating, but they want to get operating. So total operating revenues came to $1.86 billion versus $1.42 billion. If we look here, as far as expenses went, they kept everything pretty in check. They brought down entertainment, retail, and other expense quite dramatically, but also do keep in mind that revenue line item, that was the only one that fell for the company there. So operating income increased insane for the company. $362 million of operating income this latest quarter versus $169 million of operating income the same quarter last year. That's incredible. Interest expense is a trouble spot for the company. $182 million in interest expense they had to pay in this latest quarter. That is a little better than last year at 187, but it's still a huge number, right? Huge number. So net income attributable to Wynn Resorts Limited, $144 million. Very good. Diluted EPS went to $1.30 versus a 2-cent loss in the same quarter last year. So huge, monumental improvements for Wynn overall. As a shareholder of the company, I'm very, very happy with this one. Now, why is the stock not moving though, right? A minus quarter, what the heck? You look at the headlines like, oh, they beat on this, they beat on that. Why is the stock not moving? I'll tell you guys why the stock's not moving. Right here. Wynn can't win right now. They can't win because the problem is rates are high, so people don't really want to invest into a company like Wynn Resorts that has to take out a lot of debt to build new properties when rates are high. So that's no bueno. That's no good when rates are high, right? On top of that, there's a view, and this view might end up being accurate in the end. We'll see. But there's a viewpoint that when the Fed does start cutting, although you might think it would be good for a company like Wynn because then rates are coming down, which, makes, takes a lot of the burden off of Wynn in regards to, paying tons of interest expense. And if they want to build new projects, getting them at lower interest rates, things like that. There's a viewpoint that eventually recession comes as they start to lower rates, right? No different than what happened prior to the great financial crisis. They had rates up there for a while. And gosh, it's kind of looking similar, right? In terms of how high we've gone. We've gone a little bit higher than prior to the great financial crisis. But, we're kind of in this stagnant period here where the Fed's not doing anything. And then people are worried that once the Fed starts dropping, it actually means recession's coming, which is not good, obviously, for a business model like Wynn. Now, the one good thing for Wynn, though, is, I will say this, their customer base is super high-end clientele, right? Rich people have money in recessions too, okay? So that's the one good thing. But there's no doubt Wynn's business would be hit in a recession. So I think that's why Wynn can't really find buyers. And it doesn't really matter how good the earnings are in the short term. Because people just are like, rates are high. That's not good for Wynn. If rates start coming down, it means recession, which is not good for Wynn. So this is an interesting time period where I look at it, for this next, let's call it 1 to 2 years. And I think it's actually a really opportune time to just add a lot of Wynn shares over the next couple of years. Understanding, because this is one of the very few times a company like Wynn will be seen in a no-win situation. Almost any other time period, a company like Wynn, you could look at it positively, oh, rates are low, economy's getting better, things like that, right? This is kind of a freak situation that we're going to be going through for this next, I would call it year, maybe 2 years, that I look at a stock like Wynn and I'm like, I think it's actually a great buying opportunity. Now, they have this project in the Middle East that is being built right now. They shared a picture recently. I posted this picture from May 1st. Posted this inside the private group's Discord chat here of the property under construction there in the Middle East, which is a very, very exciting opportunity for the Wynn. We know how much money's in the Middle East and how much travel goes to the Middle East nowadays. So, this is what the project should look like when it's all finished. Very, very, very exciting. Very exciting opportunity. I'll say that. I mean, extremely exciting opportunity for Wynn. So that's that. We'll see what happens with the New York opportunity. The New York opportunity, I'm hoping things work out there because that would be tremendous. Okay. Oobity booba. So, Oobity booba stock fell about 6 percentage points here today. Let's look at the earnings, look at the balance sheet. Let me kind of share my thoughts in regards to Uber. So, in regards to Uber, balance sheet's looking healthy, wealthy, and stealthy. Cash and cash equivalents over $5 billion for this company. Total assets, a little under $40 billion versus total liabilities about $27 billion. So, Uber's balance sheet's looking real good here. If we look at the income statement, looking pretty good. Revenue, over $10 billion of revenue versus $8.8 billion in this same quarter last year. So that's up about $1.3 billion on a year-over-year basis. And then you look at the cost of revenue, right, exclusive of depreciation and amortization, that was about $6.1 billion. So that was up about $900 million year over year. So if your revenue is up 1.3, but your cost of revenue is up maybe 900 mil, that's going to be very good for your profitability of the company, right? Operations and support, that was up a little bit year over year. Sales and marketing, they brought that down significantly. They brought that down by over $300 million on a year over year basis. Research and development, that was up slightly. General administrative was one trouble spot for the company. General administrative went to over $1.2 billion. From $942 million, so G&A is a problem for the company. Depreciation and amortization of $190 million. If we look at total costs and expenses, $9.9 billion there. Income from operations, $172 million versus a $262 million loss in the same quarter last year. Interest expense, a problem for the company, but not as big of a problem. $124 million in interest expense versus $168 in the same quarter last year. Other income was actually an expense. That was $678 million expense for the company. So that one-off killed their profitability completely, right? Overall, I give them a B minus. If it wasn't for that one-off, I would have probably given them an A minus or a B plus for this quarter. But that one-off, obviously, you got to factor that in there. So Uber's financials, it's amazing how much Uber's financials have improved, I will say, over the past 3 years, 5 years. It's a night and day difference. Uber used to be a very easy company to poke at and be like, man, it's a famous company. It seems like everybody uses it, but man, their financials are trash. It's not like that anymore. They've completely transformed their financials. The other good thing with Uber is very early in Uber's profitability cycle. If, even a couple of years ago, you couldn't even think about, even a year ago, pretty much, couldn't even think about Uber profitability, right? And we're at a very different place at this point in time where Uber is now a profitable beast. So that bodes very, very well for the company overall, right? I don't want to say profitability beast, but they're on the path to becoming a profitability beast. I'll say that. They're not there yet, but they're on the path to be a profitability beast. If you look at this company 3 years from now and their financials 3 years from now, the profits should be immense for this company. Now, forward P on the stock 47 looks high, but remember, this is an early stage profit company, right? And I think it's on the way to becoming a profit beast over these coming years. So I think the 47 is pretty darn fair for a company like Uber. PEG ratio of about 1 in this company. I like that. Price to earnings growth. If we look at current year and next year expected revenue growth, we're talking, mid-teens, somewhere around there. So very good, strong revenue growth expected this year and next year. Significantly above where average stocks trade at, right? I'm using 1000xstocks.com for this, by the way. If you want to join the waitlist for 1000xstocks.com, literally go to 1000xstocks.com, join the waitlist for us there. And we're about 430 people deep or so now on that waitlist. If you look at EPS growth, 56%. Next year's EPS growth expected 88%. We'll see if they hit that. That'd be insane. But the bottom line with Uber is a company should increase their earnings per share at a much more rapid clip than revenue and that's honestly a trend that should transpire over this next 5 years. Literally, for the next 5 years, every single year, the earnings per share should go up 2x to 3x likely, whatever their revenue is going up, which is very exciting for this company. So I like Uber overall. Obviously as a Tesla shareholder, there's a lot of people that kind of worry about, okay, Tesla, robo-taxi opportunity. Oh my gosh, Tesla's going to have all these robo-taxis out there. It's going to completely eliminate Uber, right? As a Tesla shareholder, I wish, but I have to be realistic about this, okay? One is we don't know when robotaxis will actually be allowed on the road. It could still be years away. Could be many years away. I don't know. Okay, when will Tesla have the technology perfected in time to actually go to state agencies and the federal government and get them to allow this? Is it a year from now, 2 years from now, 3 years from now, 4 years from now? I don't know. But then there's got to be a whole decision process between different states and the federal government in general, right? That could take who knows how long, right? And it could take a lot longer, especially if people that aren't really Elon's friends are in power at that particular time, right? Another thing to keep in mind there. So that's something to factor in. And then also in regards to Tesla's not going to just have their own fleet only of robotaxis. It's way too big of a cost to the business model. It would completely destroy all profitability for Tesla, and Tesla would have to start losing billions of dollars literally a year if they wanted to build their own fleet, because that would be so dang expensive. And the payback is not overnight on that. So what Tesla's likely going to do when we finally do get, Tesla has a technology to have robotaxis, plus Tesla can get it past states and the federal government, right? At that point in time, then Tesla's going to leverage likely individual operators. They're going to leverage their current customer base. They're going to leverage, folks that will probably go through Uber. They'll leverage Uber as well. And so I see there being many players in the space. And so to think like, Tesla's just, a year from now is going to have all the technology and they're going to be allowed to do everything. Like I said, I wish that was the case as a big Tesla shareholder, but it's a fairy tale. It's a fairy tale in regards to thinking this is just going to happen all really quick and Tesla's going to have the whole market and everybody's going to be driving around robo-taxis. It will happen long term, but it's not happening overnight, right? Which gives Uber plenty of time to find their place in there, fit in their spot, and do all those sorts of things. So overall, I will say for Uber long term, the best thing likely to transpire for Uber will be self-driving vehicles. And the reason being is, Travis put it best many years ago. A lot of people didn't like that, but he said the biggest cost to us is the person in the front seat. And it's true. It's just a huge line item, right? And so if Uber could have robo-taxis driving around, believe me, they would love that, because then we're talking about just profitability goes up quite immensely for the company. Now, I just added Uber onto my possible buys watch list, but here's the deal. It's one of 17 stocks on my possible buys watch list for this quarter. A lot of these stocks I already have positions in. Some of them I don't. Some of them are new potential stocks, one of 17. And I tried to just, get that list narrowed down. By the way, if you ever want to see that entire list, let me know in the comments down there. I can do a video covering all the stocks that are possible buys for me over the next couple months. Just let me know if you guys are interested in a video like that. I can always do something like that. But man, it's one of 17 stocks. My issue right now, and this is how I feel like I'm at a freaking buffet. You ever been to a great buffet before and you're looking and you're like, oh my gosh. Like, go to the Wynn buffet sometime when you're in Vegas. Go to the Wynn buffet and you're like, dude, everything looks so freaking good. I want to eat everything. I want to eat it all. Like, oh my gosh, I want that. I want that. I want that. I want that. And that's how I feel in this market. There's a lot of opportunities now. A lot of opportunities. The stock market might be at all-time highs or near all-time highs because a few of the biggest companies have held up really well. But there's a lot of collateral damage beneath the 10 or 15 biggest stocks in the market. A lot of damage. And I look out there and I'm like, dang. There are so many opportunities. I see opportunities in some small caps, right? I see opportunities in some mid caps. I see some opportunities in some large caps. I see opportunities in some growth stocks. I see opportunities in some dividend and value stocks. I see it's a buffet out there right now. And I'm like, man, we haven't even really seen the whole market drop. If we got the whole market to drop, that would just be like, oh my gosh, fill up your belly, eat as much as you possibly can, because that'd just be insane. But I like what I see. I like what I see a lot. I'm seeing a lot of good values as somebody that looks out and is buying companies for the next 3, 5, 7 years. Like, a lot of these valuations I'm starting to get on some of these stocks is getting much more interesting for a lot of these companies than we were at 2 months ago even. Because 2 months ago, a lot of these stocks were 20, 30, 40% higher than where they are today. So we're not talking about a small amount. We're talking about a large amount. I was speaking about on the reaction channel. If you don't follow my reaction channel, Jeremy Lefebvre Makes Money, right? I was speaking today about how a lot of these Wall Streeters, they do groupthink. And so when I say groupthink, basically they come out with this thought process and then they all start running with it. So the recent thought process from Wall Streeters is the markets ran a lot. Let's take some profits. Let's take some profits. Let's take some off the table. It's been a great run. And so what happens is even if Wall Streeters are like, let's just sell out of 5% of our positions or 10%, which doesn't seem like a big number. When they all start discussing that and they all start thinking that, it can cause stocks to go down 15, 20, 30, 40% in a matter of days or weeks. We're not talking months. We're not talking years. We're talking days and weeks. You can see 15, 20, 30, 40% drops in stocks, right? Because it puts so much selling pressure. And if simultaneously you got Wall Streeters kind of not wanting to add because they're kind of more in the thought process of let me cash up a little bit, let me lighten up my positions, then where's the buying pressure? It's just not there at that particular time. And that's how you can see some of these major drops. A Shopify today, was the guidance bad? No, it wasn't even a bad guidance. Maybe it was potentially 1 percentage point, 2 percentage points under kind of what people were thinking. Is that some end of the world drop the stock nearly 20 percentage points? No. But if you have a lot of people that are kind of already in that thought process, right? Look at Palantir's numbers. Palantir numbers were great. Great earnings, great numbers, right? 21% revenue growth, earnings per share are going to the moon, is phenomenal, right? But yet, look at Palantir stock. It dropped 14+% the next day because, the Wall Streeters start thinking groupthink, and if they all want to jump on one side, they're going to jump on one side, and it will cause a stock to fall. But at the end of the day, you just got to understand, that's all short-term stuff. And, a lot of these companies are set up very, very well for the long term. I think Palantir is set up very well for the next 5-10 years. I think Shopify is set up very well for the next 5-10 years. I think Tesla is set up very well for the next 5-10 years. I think Meta is set up very well for the next 5-10 years. I think PayPal is set up very well for the next 5-10 years. Amazon. And so that's where I look out there and I'd say, you guys can play your game, Wall Streeters. I'll play my game. I'll find these opportunities. I'll buy great companies. You guys are going to be willing to pay 50% premiums, 100% premiums, 200% premiums in the future for these same companies that you can sell. And that will be that, right? And it wasn't that long ago. Shopify was, there wasn't that long ago. People were paying $150 plus for Shopify stock. It was just a few years ago, right? And now people want to dump it at 60. In a few years, and back in 2022, there was people dumping it under $30. And that was absolute insanity, right? And so, those are the games that are played out there. But at the end of the day, man, there's a lot of opportunities in this market. It's a buffet, folks. It's a buffet out there. And if we can get this market to drop, the buffet is going to look even better. So we'll see. But it's been a very intriguing earnings season overall. And, my hope is for more weakness in this market overall because I would just love more buying opportunities. I got a good amount of cash. I'm ready to buy. And there's going to be a lot of money to be made on the other side, man. A lot of money. A lot of money to be made on the other side, folks. Hope you enjoyed today's video. I appreciate y'all joining me. If you're looking to get access to all my course curriculums and learn everything I got up in here in this bald head, then check out the pinned comment down there. Fill in an application. We'll see if we can get you in my private stock group next week. That's access to all my best course curriculums, access to 6- and 7-figure Discord chat. Take your game up to a much higher level. That's what these folks have done. We've had a countless amount of folks reach 6 figures, 7 figures, 8 figures that have gone through the group over time and learned and been able to make much better decisions overall for themselves. Appreciate y'all. Much love as always, and have a great day.